It's Friday, 17th of October, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Joining me once again, Group Chief Economist Neil Shearing and our special guest, Julian Evans-Pritchard, who is head of our China Economics Service. Hi, guys.
Hi, David.
Hi, David.
Now, usually on these podcasts, we stick to this capital economics ethos of delivering insight in as concise a package as possible, keep the recordings bite-sized. But I think this week we're going to stretch out a bit because, frankly, the topic demands it. We've had this flare-up of US-China tensions. In just over a week, publicly at least, we've gone from relative calm, positive vibes to something a bit more poisonous. We've had these new regulations from China on rare earths. There have been the imposition of port fees. We've had new threats on everything from cooking oil to software to a return to triple-digit tariff rates. China's government saying we don't want a trade war, but we're not afraid of it. The US Treasury Secretary calling out one of his Chinese counterparts as being, quote-unquote, slightly unhinged. Compared to where we were just a few weeks ago, this is all a bit troubling, isn't it? Julian, can you just cut through all of this noise that we've had over the past 8 or so days and explain exactly what's been going on? And before you do, I should timestamp this. We're speaking about 9:15 on Friday morning, London time. So where are we now? And frankly, how did we get here?
Well, if you rewind the clock back a month ago, you think back to the US-China trade talks in Madrid, the relationship seemed on fairly stable grounds at the time. Both sides managed to agree to an understanding over a deal over TikTok. So things seem to be going fairly okay. And then over the past month, the situation has really deteriorated, particularly over the past week. And I think the Chinese would argue that the catalyst for that really came back in late September when the US expanded their entity list and basically made it apply much more broadly, not just to the companies that are on the list, but also their subsidiaries as well. And then shortly after that, they also signaled that they were going to proceed with the port fees on Chinese ships. And I think the Chinese basically saw this as an escalation, even though the US probably saw this as just continued maintenance of existing controls or controls that were already planned for the trade truce. But I think the Chinese basically were starting to get a bit frustrated at the fact that despite this supposed truce that they had, the US was continuing to hit them with additional measures and didn't really seem to be showing much interest in reducing the tariffs further. In fact, the sort of signaling out of the Trump administration at that point was that they were quite happy with a 40% tariff on China, and that was the deal that they were working towards. And so I think, understandably, China hit back, and obviously the rare earth export controls in particular certainly struck a nerve in Washington. And after that, obviously the Trump administration has hit back hard with a threat of 100% tariff on Chinese goods and some additional export controls as well. So things have been blown off course. I think both sides are basically blaming it on the other side. And so, at this stage, it's kind of hard to see how this will be easily resolved, given that both sides seem to be sort of talking over each other.
Those rare earth regulations, they're very much at the heart of this latest spat. But it's not just Washington complaining, it's the EU is complaining about them as well. Why has there been such a reaction?
Well, I think part of the reason is that there was maybe a bit of a misunderstanding over the scope of these controls. So there's some wording in the controls which basically says that if you're a foreign company producing a good even outside of China, if that product contains more than 0.1% of controlled Chinese rare earths, then you will be required to get an export license to export that product. And that was widely seen as extremely aggressive, and basically China laying claim to huge parts of the global manufacturing supply chain because, of course, rare earths are very widely used in many products. In reality, our reading of the controls is that they only apply to a specific list of rare earth magnets and materials. So I don't think they apply to every single product that contains small amounts of rare earths, but that's certainly how it was interpreted across the globe. And even, to be honest, even if it is narrow in scope as we think, it's still a pretty substantial move. We saw back in April that even much more narrow controls on rare earths can cause a lot of disruption. Back in May and July, the executives of many automobile manufacturers were warning that they could soon have to pause production on certain assembly lines because of shortages of rare earth magnets. And so by bringing this rare earth issue back to the surface, I think they reignited a lot of concerns, not just in the US, but globally, about China using its dominant position in these minerals to disrupt production globally.
My take here is that there's two things going on. There's two drivers of this. There's a kind of geopolitical driver and there's a more narrow economic driver. The geopolitical one is that we've talked in the past, haven't we, a lot. I've written the book on fracturing, this idea that global economy is pulling into two blocks, one centered around the US, another centered around China. When you look at the world through the lens of fracturing, then a control over the global supply of critical minerals, including rare earths, is one area where China undoubtedly has the upper hand over the US. So I think there is the fact that China is now kind of weaponizing this, or being perceived to be weaponizing this in Washington, is feeding into kind of concerns and provoking this backlash. So there's a geopolitical angle to this, but there's also a narrow economic one. I tear my hair out with a number of analyst reports that I've seen saying, oh, the US only imports a few $100 million worth of rare earths from China each year. This is not a big deal from a macro perspective. And it's true that the value of imports of rare earths from China to the US is small. But the analogy here is that rare earths are the weakest link in an incredibly long global supply chain. And if you remove that link, then entire global supply chains collapse. If you can't get certain rare earth, the global auto supply chain will collapse. The global aerospace supply chain will collapse. The global consumer electronics supply chain will collapse. So just because the US does not import vast amounts of rare earths in value terms from China does not mean that they're not economically important. So the fact that China is being perceived to kind of weaponize or exert control over this supply, I think has raised both concerns of a geopolitical nature in Washington, but also a more narrow economic one.
It's also striking, isn't it? I should actually say before that, the thing about rare earths is that they're not rare, because I think we're obligated to say that every time we talk about rare earths.
I think we should call them dirtier. The point is they're not rare, but they're just incredibly dirty to extract and you require some pollution. And frankly, the West was complicit in essentially offshoring all of this dirty extraction to China 30 years ago because we thought the world was going to turn out slightly differently. And clearly, we now live in a world where the geopolitical reality is somewhat different.
What's striking as well, actually, is the Chinese response in trying to defend these regulations in subsequent commas from MOFCOM is the US has been imposing these controls on technology. Why can't we introduce this license regime, which is frankly what it is, for these rare earths? And so, it's not out of the ordinary in that regard. But the timing is interesting, isn't it? Because if you look at the spectrum of opinion about why now, it runs from this is all just brinkmanship because Xi Jinping and Donald Trump are still, I believe, planning to meet in Korea. I think it's the end of this month, week after next, on the sidelines of the APEC meeting. So it goes from that to actually this is a dangerous escalation in a long-running and frankly inevitable confrontation. So where is it between that spectrum of brinkmanship versus superpower confrontation? Where do these regulations sit?
I think it's fertile ground for hot takes, isn't it, whenever events like these occur? And I think the truth is always a bit more nuanced. I think there's undoubtedly a sense in which both sides are trying to increase their bargaining position, improve their bargaining position ahead of talks at the end of this month, which, as you say, as we speak, are still due to go ahead, we believe. So I think there's an element to this in which both sides are trying to improve their bargaining position, make it known to each other that they have levers they can pull that would impose costs on the other side. I also think it's notable, by the way, that China imposed these curbs. The US responded. Then there was quite a violent reaction in late trading on Friday last week in the stock market. The stock market sold off quite aggressively. And then over the weekend, President Trump kind of dialed some of the rhetoric down and dialed things back a bit. So again, perhaps another reminder that anything that is going to produce really violent reactions that the administration might try to walk back. But I think that the key to understanding really what's going on in all of this is something that Julian alluded to earlier, which is the way that these controls, these export curbs on rare earths were announced by MOFCOM was really interesting. It was almost designed to kind of sow confusion and obfuscate about what was really going on. The manner in which it was published, I think I'm right in saying, Julian, there wasn't an English language version of the press release. It wasn't even released in a form that was accessible on some forms of US software. So the manner in which this was communicated was almost as though it was designed to sow confusion. And I think that speaks to something much broader that's going on between the two sides. There's lots of hope and optimism around these talks at the end of the month that this might lead to some kind of détente between the US and China. And it might, in a narrow sense. I suspect it will produce some kind of deal, not least because neither leader was going to go to Korea and agree to meet and have a press conference and so on and so forth without there being some document that they can point to at the end of all of this that both sides can claim to be a success. However, does that lead to a lasting reset in relations between both countries? I don't think so. And what we've seen over the past week or so has been the extent to which strains in the relationship between the US and China go well beyond just trade and tariffs. Now we're into rare earths. We've written over the past week about how this could extend into investment controls. And this again speaks to this kind of fundamental underpinning here, which is an intensification of the geopolitical rivalry between the US and China.
Based on what Neil said, Julian, I mean, what are we expecting from APEC? Clearly, there's an off-ramp available in China just rescinding these regulations or making it clear that they're going to shelve them for now. It wouldn't be the first time that's happened. How do you see this panning out between now and this meeting at the end of the month, presuming it goes ahead? I mean, maybe there's a risk it doesn't happen.
Yeah, I mean, just building on Neil's point on fracturing, I do think that there's these fundamental geopolitical forces that are pushing the countries apart. And for that reason, I think the Chinese will be quite reluctant to fully reverse these controls because they think that these controls serve a geostrategic purpose over the medium term in preventing rare earths from ending up in the hands of particularly Western defense companies. And so, I think they'll be reluctant to fully roll them back, but probably they will be willing to agree to implement them in a very narrow manner or maybe delay their implementation. So they might offer some concessions in that regard. But what worries me is that the language out of the Trump administration at the moment is all about, China needs to fully back down, completely reverse these restrictions. And I think that the Chinese will be quite reluctant to do that because they see these measures as quite justified and similar to the measures that the US itself has been taking. So I do think we shouldn't necessarily expect there to be a meeting or a deal at APEC. I think it's a possibility, but I think it would be complacent to count on that happening. And I do think even if there is a meeting between Trump and Xi, we probably shouldn't expect too much to come out of it. I think the best case scenario here really is we just get back to where we were a few weeks ago in terms of sort of the trade truce being back on track. I think there's still too much distrust in the relationship between the two countries to really expect much more beyond that.
It feels like we're getting further and further away, doesn't it, from this idea that there would be the equivalent of that phase one deal in the first term done, where China agrees to buy, a few Boeings, a few tons of soybeans, and there's a sort of live and let live agreement that comes out of it all. There has been some great reporting coming out of the last few days, and a lot of it seems to fit with sort of what we've seen historically in terms of Chinese internal dynamics, how the US-China bilateral relationship functions or dysfunctions for that matter. The FT, just going back to what you were saying, Neil, there's officials quoting the FT saying it wasn't clear if MOFCOM just went ahead with these rare earth regulations without coordinating with other parts of the bureaucracy, that maybe Xi Jinping wasn't even aware of them. Then you have the Wall Street Journal. They're saying, actually, all of this is part of some more assertive posture from Beijing, and it's being fed by the taco Trump idea. Trump always chickens out. Xi Jinping calculating that Trump will basically fold. Feels like the big takeaway from all this reporting is that there is this heightened chance of miscalculation, that we're getting further and further away from the possibility of some kind of fundamental settlement, and that we're going to wind up with outcomes that neither side intended. Neil, how would you frame all of this?
I think that's exactly the right way to frame it. I mean, you're right. Some of the reporting has been great, although it has been perhaps inconsistent. And of course, we're viewing all of this through a Western lens, a US lens. If you view things through the lens of Beijing, then equally there's kind of equal amounts of kind of confusion as to the motivations on the US side, and who's really in control and what are the intentions. So neither side properly understands one another. There are conflicting signals coming out of both sides. And this gets to the heart of something much more fundamental, which is something that Julian just touched on, which is that if you think about the conditions you need for a lasting reset in relations, then both sides need to be able to feel they can trust one another. And the events of the past 2 weeks or so illustrate why those conditions are going to be difficult to create, because there is, I think, a fundamental misunderstanding of the intentions on both sides. There's the scope for escalation, but also I think we're getting to the stage where neither side really trusts the intentions of the other one.
Julian, what do you think Beijing wants out of all of this? Realistically, what do you think Beijing is trying to achieve in the near term?
So I think China's strategy is to gradually decouple from the US and the West more generally, but to try to do that in a managed way. So basically, over time, through technological developments, to reduce their dependence on Western technology, Western inputs. But in the meantime, I think they want to make sure that they can still access those inputs. And so I think they're trying to use some of the leverage that they have with rare earths and in other areas to try and extract some concessions from the US in terms of reduced tariff barriers and export controls. But I don't think that they really want to establish much closer economic ties with the West again, for the reasons that Neil discussed, is that they just don't trust the intentions of the US. And so over the medium long term, they want to minimize their exposure and their economic ties with the US.
I mentioned cooking oil and software at the top as sort of potential areas where we could see further restrictions in terms of the flow of trade. The flip side of China perhaps getting some concessions from the US is that actually we get tighter controls. We get more restrictions from the US. So what other sectors do you think are vulnerable? Where do we go next from here?
Well, there is a risk here that China's sort of hardball strategy may backfire somewhat if it pushes the US to adopt an even more aggressive stance. And we talked about tariffs, we talked about cooking oil and aviation components, but I think it could expand beyond trade as well. The focus at the moment is very much on trade, but of course, China is still quite dependent on the US financial system, on US capital. And the Trump administration already back in February detailed their intention to significantly increase curbs on capital flows and investment flows with China. And that's something that they haven't really followed through on at this point. But certainly if the relationship deteriorates, I think it's something that we could see come back onto the agenda in the US. And that could cause difficulties for some Chinese companies, particularly those that are dependent on the US capital markets, and likely to have some knock-on ramifications for China's equity performance and the exchange rate, et cetera. So, I do think we could see things escalate beyond trade to financial flows. But in terms of trade, of course, I think the biggest vulnerability that China has is still semiconductors. Obviously, the US has already done quite a lot on that front, but at this stage, it's only targeted very high-end semiconductors, particularly those for AI. But of course, it could expand those controls. And at this point in time, China is still quite dependent on Western technology, particularly the capital goods, the machinery that goes into producing its semiconductors. And so that's a significant point of leverage that the US still has and could lean on more heavily.
That word leverage is pretty key here, isn't it? It kind of ties in with this idea of miscalculation that we were just talking about. Scott Bessent, Treasury Secretary, saying earlier this week, China's in a depression and they want to export their way out of it. And there's this notion, this idea on the US side that China's economic weakness is behind a lot of what's going on. In China, there's been this long established idea that the US is in decline. More recently, that Trump's policies are hastening a loss of global influence. Just on the Chinese side, what is the macroeconomic reality here, Julian? I mean, I know you've been covering China's economic slowdown for years, but do you think that Bessent's framing around recession, or I think you said depression, is at all useful?
Well, I think both sides overestimate the weakness of the other side. And when it comes to, those comments that Bessent made, I find it hard to draw a line but from those comments to what I'm seeing in the data on how the Chinese economy is performing. Now, to be sure, the Chinese economy is pretty weak. On our own in-house measure of growth, the China Activity Proxy, growth is currently around 3%. So by historic standards, certainly for China, that's pretty slow. But growth is not falling off a cliff. In fact, it's been fairly stable since the start of this year. And so despite this big increase in US tariffs on China, that hasn't really had a dramatic impact on China's growth trajectory. And most of the problems in the Chinese economy are domestic in nature. So, I think these threats of additional tariffs, while they would have some impact on the Chinese economy if they were enforced, I don't think they're going to tip the Chinese economy into recession. And I don't think that the US has as much leverage in that regard as it thinks it has.
We are talking just ahead of another plenum in China, Communist Party meeting, talking about the next 5-year plan. This is one that's going to run through the end of this decade. How much do you think it's going to reflect a sort of strategic assessment of this fracturing that you and Neil have been talking about, and what Trump's doing to sort of remake the American project? Do you think it's going to inform all of that?
I think it could be one of the more lasting legacies of the trade war, both the current trade war and going all the way back to the trade war during Trump's first term, particularly some of the measures that Trump took during his first term around export controls on ZTE, a Chinese telecom company, and Huawei. They really sowed the seeds for a lot of the economic security agenda that's currently being pursued in China, and the self-sufficiency agenda, and this attempt to reduce reliance on Western technology and improve China's own technological capabilities. And that seems like something that they're likely to double down on in the upcoming 5-year plan. Obviously, we don't know at this stage. We haven't seen the plans yet, but most of the signals from the state media in recent weeks suggest that that's going to continue to be a key focus. And I think the issue for the domestic Chinese economy is that this focus on industrial policy is coming somewhat at the expense of policies that could rebalance the economy towards consumption and improve broader economic growth. To some extent, these industrial policies are shifting resources away from the household sector towards the industrial sector. And although you could argue that they've been quite successful in a narrow sense, in that they delivered technological gains in the sectors that the government is targeting, on a sort of wider macro level, the productivity gains from this industrial policy have actually been pretty disappointing. And we put out a piece earlier this year, basically trying to square this disconnect between, on the one hand, China's technological gains in these sectors, but at the same time, the continued slowdown in total factor productivity growth that we've seen in the broader economy. And I think those two things are very much related and partly a reflection of this focus on industrial policy. And that's very much a consequence of US-China tensions.
So there's a legacy there. What about globally then? Neil, we just put out our global economic outlook and it paints a relatively benign picture for 2026. Let me ask you two things. Near term, does this flare up in US-China tensions and the sort of the fundamental drivers that you've been talking about? Is that a risk to this relatively benign outlook? But then also looking longer term, you mentioned your book, you've got this framework for this process of fracturing where US-China ties in strategic areas, those get broken, those get disrupted, those flows of goods and services and people indeed are redirected in the global economy over several years. But at the same time, you talk about how a chunk of the trading relationship will still exist, that the Americans will still buy furniture that's made in China, et cetera, et cetera. Is there a heightened risk now that we get a less benign outcome than one that's at the heart of your assumption for where the global economy is going?
Just on the economic outlook, it's striking. We're talking a few days after the IMF's just produced its World Economic Outlook for October 2025. I read that earlier this week. It's incredibly gloomy in its language. And then when I looked at the numbers, actually their forecast for global growth this year is a bit above ours. And yet when you look at our global economic outlook, I've characterized the global economy as muddling through, pretty weak. Growth is kind of solid, but not spectacular. And yet our rhetoric is somewhat different from the IMF. So point being here that your starting point in the way in which you frame the challenges, I think, matters. And different institutions interpret different outlooks in different ways. Now, I would characterize, as I say, the global economy as muddling through. Now, why is it muddling through and how are global supply chains and trade flows adapting to these tariffs? I think that is the critical question we need to answer. And when we look at what's happened to China's exports to the US in the face of these tariffs, they've collapsed. Julian's just talked about how China's economy is not in a depression, but it's in a soft spot. The strong part of the Chinese economy over the past 3 or 4 years has been its export sector. And yet exports to the world's largest consumer, the US, have fallen off a cliff. They're down by 30% over the past year. They're now running on some measures at their lowest level since 2012. So there's clearly something happening with bilateral trade to the US. And yet China's exports as a whole are close to record highs and they're growing by 8% year on year. So how can we square the fact that China's exports to the world's major consumer, the world's largest importer, have fallen off a cliff, yet China's exports as a whole are holding up relatively well and indeed growing? Part of the answer is that other economies are absorbing some of China's surplus and some of China's exports. We wrote a piece earlier this year exploring how emerging economies are a growing export destination for China. There's also likely that some rerouting is going on, although according to our estimates, that's happening on a much smaller scale, so far at least, than what was the case in the first trade war. But I think there's also a danger here of conflating bilateral trade balances and aggregate trade balances. If you look at what's happening in the data, one way of thinking about what's happening to the world is that the US is providing demand to economies outside of China. It's still running this enormous trade deficit and current account deficit. And those countries are supplying demand to China and allowing China to run this trade surplus. So we still have a world in which the world's biggest consumer, the US, is importing vast swathes and running a large current account deficit. And that's facilitating one way or another China running this large external surplus. And as a result, the global economy is muddling through in the face of these tariffs, even though the tariffs themselves are having a major effect on the bilateral trade balance between the US and China. So there's lots going on under the hood, but I think what we're seeing when you step back is the flexibility of global supply chains and the adaptability of the global economy more generally. And that's allowing, I think, in general, the global economy to muddle through. Now, the second part of your question is beyond the next 6-12 months, might we see this fracturing between the US and China evolve in a way that produces more adverse economic consequences? We're no longer muddling through. Actually, we're in for a period of much, much weaker growth, even recession. And in order to get that, then I think we need to see a much broader splintering in relations between the world's two largest economies. So far, there's been a drop-off in trade, but not a complete kind of cessation of trade. And global supply chains have adapted such that we've been able to kind of push demand around various different bits of the global economy, and output and activity as a result have not collapsed. There's an interesting piece of work done by the IMF a couple of years ago that looked at what would happen if two blocks, one around the US and one centered around China, just ceased all interaction with each other in an economic sense. All trade, all capital flows, all technology flows ceased to exist. And their findings were that if that happened in a gradual way, then the economic costs on a global scale would be equivalent to about 2 to 3% of global GDP. If it happened very, very quickly, then the costs would increase to 6 to 7% of global GDP. So in answer to the question, what are the risks that this evolves into something more serious and what might the economic costs be, then I think the key thing we need to keep an eye on is whether or not these safety valves within the global economy, the flexibility, adaptability of global supply chains are no longer allowed to function, that there's a much harder split and broader split between these two blocks, and the speed at which that happens. And as I say, if we're looking for more extreme outcomes, then that could produce global losses in terms of global GDP, anywhere between 2% of world GDP and up to 7%, depending on how quickly that happens.
And can I ask both of you, has the mood shift over the last 9 days, has that affected in any way your thinking about your assumptions about where we're going?
Not necessarily, no. I think these things always ebb and flow. It always feels like often, the peak of Liberation Day, it felt like the US was pulling back from the world more generally, including its allies, not just China. And I thought that was a bit overdone. And since then, of course, we've seen deals between the US and its allies on much more favorable terms than that's been done between the US and China. Equally, we then go through a period where everyone forgets about trade and tariffs and rare earth controls, and we talked a bit about investment controls that's not even on the agenda, and then suddenly it flares up. So I don't think these issues are going away, nor do I think they necessarily presage a much harder split between the two blocks. My base case, although it's obviously extremely uncertain, and as we've written about, the range of possible outcomes are now much higher than I think was the case 12, 18 months ago. I think the reasonable base case is that this is a kind of contained, limited form of fracturing. US allies kind of continue to coalesce around the US, and that the economic costs are manageable. But as I say, clearly the risks have increased, but I don't think I'm yet ready to make that my base case.
Julian, do you want to add anything?
Yeah, sure. In terms of US-China relations, it does feel a bit like it's always 2 steps forward and then 1 step back in terms of escalation. Obviously, we had the trade truce earlier this year, but it didn't really fully roll back all of the measures that both sides had implemented early in the year. And I think we could be in the midst of a sort of similar scenario in which potentially, this all blows over, we get a deal at APEC and things go back to the truce that we were in before. Or I think we could get another round of escalation. Maybe that 100% tariff comes in briefly. But I do think there's a lot of incentives for both sides to try to row things back again if we do end up in that position. So, I think expect more volatility in the relationship. And I think the medium-term, long-term direction is clear in terms of continued gradual fracturing or decoupling. But I think there's going to be a lot of sort of back and forward. It's not going to be sort of a linear path in that direction.
Julian Evans-Pritchard and Neil Shearing there on the intensifying US-China tensions of recent days and what they all mean. Clearly, this is not an issue that's going to go away anytime soon, and as they touched on, the team has produced a load of analysis about what's happening, where it's all going, and what it all means for the global economy. Some pieces that I'd highlight are this analysis about potential Trump administration moves to kick Chinese firms out of US capital markets, our latest China activity proxy reading, this disconnect between China's technology leadership, but at the same time its low productivity levels, and our Q4 global economic outlook. I'll link to all of those in the podcast notes. Neil's book, The Fractured Age, is available in all good bookshops and, as he likes to say these days, in some not-so-good bookshops as well. It's based on a giant body of work produced in recent years across the Capital Economics team, and we have a dedicated fracturing hub which houses all of that work. Again, I will link to that in the podcast notes. If you're not already getting our analysis on global economic fracturing, you want to learn more about how our Economist team can help you navigate through all these uncertainties, do get in touch. sales@capitaleconomics.com. But that's it for this week. We'll be back next week with the latest on US-China relations, but also a preview of the upcoming policy meetings from the ECB, the Bank of England, and of course the Federal Reserve. Until then, goodbye